Okay, let's unpack this. Imagine a world where your standard smartphone, anywhere on Earth, never loses signal. No more dead zones, no matter how remote. That's the audacious vision of AST SpaceMobile, a company aiming to be the cell tower in space. But here's where it gets really interesting and, frankly, a bit nail-biting for investors. This isn't your typical investment story. Our deep dive today reveals a company that's either poised for a monumental breakthrough, becoming an indispensable part of global infrastructure, or it's a high-stakes gamble with basically no room for error. We're talking about a binary outcome, really. A venture capital-style opportunity presented on the public markets. Today, we're diving deep into AST SpaceMobile, trading as ASTs on the NASDAQ. Their mission is truly ambitious to build the first space-based cellular broadband network that connects directly to unmodified mobile devices. Our goal here is to extract the most important insights from the sources we've gathered to help you understand this incredibly complex, high-risk, high-reward investment opportunity. We'll meticulously explore its business, the people leading it, its financials, market position, the inherent risks, and finally, its valuation. We've structured this conversation into two parts, guiding you through key chapters, starting with the very foundation of the company. Let's begin by laying that groundwork. To truly grasp what AST SpaceMobile is, we need to understand the core of its business, the individual steering the ship, and its current financial reality. Chapter 1. Business Understanding. All right, so at its core, what cosmic problem is AST SpaceMobile trying to fix, and how are they proposing to do it in a way no one else has managed? The problem is pretty stark. Billions of people globally remain unconnected, and terrestrial cellular networks only cover about, 15% of Earth's surface? That leaves massive dead zones, think oceans, remote deserts, even just a few miles outside of major cities sometimes. AST SpaceMobile's core solution isn't just space-based cellular broadband, it's doing it directly with standard unmodified smartphones. That's the critical differentiator here. If you don't need a special satellite phone or, some bulky attachment. This offers immense value for mobile network operators, or MNOs. Those are your AT&Ts, Verizons, Vodafones of the world. For them, it's potentially a capital-light solution to finally achieve 100% geographic coverage for their customers, solving a major pain point without building tons more expensive ground infrastructure.
And the feasibility of that audacious vision, as you said, hinges entirely on some pretty advanced technology. What's truly fascinating is how their extensive patent portfolio creates a formidable legal and technical moat, effectively protecting their core innovation. You asked how they do it differently. This is a big part of it. The backbone of their network will be these Bluebird satellites in low Earth orbit that's orbiting much closer to Earth than traditional geostationary satellites, which allows for stronger, faster signals. These Bluebird satellites feature exceptionally large phased array antennas. We're talking up to 2,400 square feet for the upcoming Block 2 versions. Just massive. This huge size is absolutely crucial. It's needed to generate a strong enough signal to reach a standard smartphone on the ground, and just as importantly, detect its faint return signal way back up in space.
Right, 2,400 square feet, that's enormous for a satellite antenna. Has this kind of technology actually been proven to work? Is it just theoretical?
No, it's not just theory anymore. We saw this technology validated by their Blue Walker 3, or BW3, test satellite, which launched back in September 2022. Then in 2023, BW3 successfully completed the first ever space-based voice calls using regular phones. And it even achieved pretty impressive 4G and 5G speeds, somewhere between 10 and 21 megabits per second.
Okay, so real calls, real data speeds.
Exactly. This is a critical de-risking event. It demonstrated the core technology functions as intended. And looking ahead, they just launched their first 5 commercial Block 1 satellites this month, September 2024. They're similar in size to BW3, but are designed to offer 10 times the throughput. Future blocks are planned to integrate their custom AST 5000 ASIC chip. That's an application-specific integrated circuit, basically a specialized chip designed to do one thing incredibly well: process signals faster, more efficiently. The aim there is up to 120 metaps per cell.
Wow, 120 metaps direct to a phone from space. That's game-changing if they pull it off.
It really is. And all of this is underpinned by, get this, over 3,300 patent and patent-pending claims globally. It's not just a handful of patents. It's like building a Great Wall of China of intellectual property, making it incredibly difficult for anyone else to just copy what AST SpaceMobile is building.
That sounds like a serious competitive advantage right there, that IP wall. So how does a company with this kind of cutting-edge tech actually plan to make money? Are they selling directly to you and me? Not at all. And that's where their business model is, well, quite brilliant, frankly. It's a wholesale B2B approach. Instead of competing head-on with the MNOs, AST SpaceMobile partners with them, providing network access. Then the MNOs, who already have massive customer bases and billing systems in place, offer the service to their customers. This is smart because AST SpaceMobile gains immediate access to potentially billions of customers and, importantly, the licensed spectrum those MNOs hold without having to shoulder huge marketing and customer service costs.
Right. And the MNOs win too. They get ubiquitous coverage without the massive capital expenditures needed to build towers everywhere. It's a symbiotic relationship, ideally.
Exactly. The primary revenue stream will come from revenue sharing agreements with these partners. They also have a secondary but strategically important revenue stream from U.S. government contracts, bringing in around $4.4 million in 2024.
Yeah. Those government contracts, while small revenue-wise now, provide early funding and also serve as important third-party validation for their technology. It adds credibility.
Good point. Okay, now that we understand the core business and the tech, let's turn our attention to the individuals behind this monumental effort and how they're fueling its growth. Chapter 2, Management and Capital Allocation. Building a global satellite network from scratch requires, well, an extraordinary team and some very shrewd financial management. Who are the people steering this incredibly ambitious ship, and how are they handling the immense capital required?
Well, the company is founder-led by CEO Abel Avellan. He's a serial entrepreneur with over 25 years in the satellite industry, and he previously built and sold a company called EMC for $550 million. So he has experience.
And he's not just a business guy, he's also a significant inventor with numerous patents himself.
Right.
That's deeply involved in the tech. That's right. And his executive team looks equally experienced. The president, Scott Wisniewski, comes from Barclays, the CTO, Dr. Hu-Wen Yao from Northrop Grumman. So you've got a blend of finance and deep aerospace tech expertise. Plus, their board of directors is pretty stacked. It includes senior executives and representatives from key strategic investors like Vodafone, Rakuten, American Tower, and KKR.
Having those big strategic partners on the board ensures strong alignment and oversight. That's definitely important for a venture of this scale and risk profile. Which brings us to funding. One of the biggest questions for a pre-revenue company needing billions is, how do they secure such massive funding? How has management managed that? Your financing strategy seems remarkably successful so far. They had that $462 million SAC merger to go public. They secured significant strategic investments from giants like Google, AT&T, and Vodafone. And more recently, they completed a $575 million convertible senior notes offering in mid-2025. It shows a strong ability to articulate their vision and attracts sophisticated investors even before generating significant revenue.
So they've been successful at raising cash. Where's it all going?
Pretty much where you'd expect. Substantial capital expenditures, or CapEx. It's going into satellite design, manufacturing, and of course, launch costs. Their CapEx notably surged. You can see it jump from about $124 million in Q1 2025 to over $320 million in Q2 2025. That acceleration is key as they push towards deploying those first 45 to 60 satellites by the end of 2026.
Makes sense. And dividends, I assume that's a no-go for now.
Absolutely not. As expected for a company in this high-growth pre-profitability stage, there are no dividends. All available capital is being reinvested directly into building out this ambitious network. The substantial cash position they've built is, essentially, the company's fuel tank. It's what they need for the very ambitious journey ahead.
Okay, they're clearly in a heavy investment phase, burning cash to build the dream. But how do those massive investments translate onto their actual financial statements? Let's look closer. Chapter 3, Financials, the race against time. Right, when you're building something this massive and complex, the financials tell a unique story. It's less about profits right now and more about survival and runway. How long can they keep going? On the income statement, as we mentioned, AST SpaceMobile is essentially pre-revenue from its core space mobile service. They did report that minor $4.42 million in revenue in 2024, mostly from government contracts and some equipment resale. But as you'd absolutely expect for a company building out this kind of infrastructure, they are profoundly unprofitable. Net losses have significantly widened.
Yeah, they went from just under $32 million in 2022 to over $300 million in 2024, and now over $350 million for the trailing 12 months ending June 2025.
Those widening losses are a stark reminder of the build first, monetize later model inherent in these big space ventures. It's not about current profitability, but about whether they can stay funded long enough to get to profitability.
Definitely. But despite that unprofitability, their balance sheet health looks quite robust, which is absolutely critical at this stage. Their current ratio is exceptionally healthy. 8.23. That means their current assets are more than 8 times their current liabilities, indicating very strong short-term liquidity.
Hmm.
They can pay their immediate bills.
And the actual cash.
As of June 30, 2025, they had around $923 million in cash and short-term investments. And after that July 2025 convertible note offering we talked about, their pro forma cash position jumped to over $1.5 billion.
Okay, so $1.5 billion in the bank. That sounds like a lot.
It is. As we said, that's the company's fuel. Their solvency also looks manageable, with a debt-to-equity ratio around 0.42 to 0.44. That's appropriate for a company without operational cash flow, but with strong strategic backing.
Okay, so they have a lot of cash, which is great, but how fast are they burning through it? Give us the stark reality of their cash flow.
Yeah, the reality is it's deeply negative for both operating and free cash flow. For the trailing 12 months ending June 2025, operating cash flow is around negative $134 million. And free cash flow, which includes those massive capital expenditures for satellites and launches, was approximately negative $677 million for the same period. That's the real burn.
Oof. So a burn rate of roughly $700 million per year, consumed by operations and actually building out that satellite network.
Exactly. So when you do the math, that $1.5 billion plus cash on hand provides a financial runway of roughly 2 years.
Roughly 2 years, yeah. Which aligns maybe a little tightly with their goal of deploying those 45, 60 satellites by the end of 2026.
This really emphasizes that any significant delays in manufacturing launch deployment would be financially perilous. It could force more capital raises, leading to substantial shareholder dilution.
They are absolutely in a critical race against time and execution milestones. Okay, we've laid the groundwork, diving deep into the company's core, its leadership, and its financial tightrope walk. Now, let's elevate our perspective. Let's zoom out to see how AST SpaceMobile fits into the broader market and what formidable foes or friends it faces out there. Chapter 4. Market landscape and economic moat. Every company operates within a larger ecosystem, right? So what does the satellite communications market actually look like, and how is ASTS positioning itself to stand out? Well, the global satellite communications, or SATCOM market, is both large and expanding. It's estimated at around $109 billion in 2025.
And projected to grow significantly, maybe to over $260 billion by 2034. That's a compound annual growth rate, or CGR, of about 10.2%. Pretty healthy growth.
Definitely. And this growth is driven by, well, an insatiable demand for connectivity, especially in underserved regions. Plus advancements in technologies like high-throughput satellites and those low Earth orbit constellations we talked about.
And the integration with 5G, expanding use cases like the Internet of Things, IoT, defense applications, in-flight connectivity, it all adds up. But what's crucial to understand is that this market has exceptionally high barriers to entry. It's not easy to just jump in. We're talking multi-billion-dollar capital requirements just to get started. Highly specialized technological expertise in things like aerospace, RF physics.
Yeah.
You need serious brain power. And that massive patent portfolio we discussed.
Right, not something you can start in your garage.
Not at all. Then there are the complex regulatory and spectrum hurdles. You need approvals from bodies like the International Telecommunication Union, ITU, and the SEC in the U.S., plus navigate rules in dozens of countries for spectrum like L-band and S-band. And don't forget launch and operational risks. Satellites are complex, launches can fail.
So these barriers, while challenging for ASTS, are also what could protect them if they succeed.
Exactly. These are the very factors that, if successfully overcome, create an exceptionally wide and durable economic moat for the successful players. This is where AST SpaceMobile hopes to build its fortress. However, we also need to consider macroeconomic headwinds, things outside their direct control.
Like what?
Well, as a capital-intensive industry, SATCOM is sensitive to interest rates that affects the cost of borrowing money. Inflation impacts the cost of materials and labor for building satellites. And even things like trade disputes. Remember those U.S. tariffs in 2025? They could potentially add 10–15% to project costs, increasing that cash burn rate even further. Geopolitical conflicts can mess with supply chains too.
Okay, so they're building this moat in a potentially tricky economic sea. Who are the other players in this arena trying to build their own castles, or perhaps even knock down AST SpaceMobiles? Who's the competition? Well, direct competitors include SpaceX's Starlink direct-to-cell service, though importantly, it's currently text-only and not the broadband ASTS is aiming for, at least not yet.
Right, the capability difference is key for now. There's also Link Global, which is trying something similar but operates on a much smaller scale currently.
Then you have indirect competitors, established players like Iridium and Globalstar. Globalstar's Apple Emergency SOS feature is a powerful niche, but these generally require specialized hardware or offer more limited services compared to the broadband vision of ASTS.
And don't forget the terrestrial MNOs themselves. Long-term, they could be competition if they significantly expand their own networks into rural and remote areas, though, as we said, that's incredibly expensive for them.
So AST SpaceMobile's potential competitive advantage, its moat, really rests on a few pillars. First, as we've hammered home, their patented technology for direct broadband connectivity to unmodified smartphones. That's the crucial differentiator, removing user friction.
No need for a special gadget. Exactly. Second, their strategic MNO partnerships are perhaps the widest part of this moat. That wholesale B2B model gives them immediate low-cost access to potentially 3 billion subscribers via partners like AT&T, Verizon, Vodafone, Rakuten. This creates high switching costs for the MNOs once they're integrated, and strong network effects. The more MNOs join, the more valuable the network becomes.
And the spectrum.
Crucially, yes. They've secured access to vital L-band and S-band spectrum rights through these partnerships and regulatory filings. That's a significant regulatory and resource barrier for anyone else. And finally, if they successfully execute their deployment of 45-60 satellites by late 2026, they could achieve a substantial first-mover advantage at a global scale for broadband direct-to-standard cell, locking in partnerships and potentially setting an industry standard.
So to quickly summarize with a SWOT, strengths are the tech, the B2B model, strong backing,
Yeah.
weaknesses. Pre-revenue, high cash burn, massive execution risk.
Right. Opportunities. Huge addressable market, government IoT expansion, threats, intense competition, especially SpaceX, tech becoming obsolete, regulatory hurdles, launch failures.
That's a comprehensive look at the market forces. But who actually owns a piece of this potential future, and what signals are they sending about their confidence? Let's look at ownership, Chapter 5. Ownership and insider activity. The ownership structure here shows a pretty strong base of institutional and strategic ownership, somewhere around 45 to 52% of the shares. This includes major players like Rakuten Group with 11.5%, Alphabet Google at 3.32%, AT&T holding 2.33%.
And big institutional investors, too, like Vanguard with 6.5% and BlackRock with nearly 4%. Having this kind of smart money backing is generally seen as a big vote of confidence in the long-term vision.
Definitely. Plus, the founder and CEO, Abel Avellan, still maintains a significant stake, around 23% through his Class C stock. So his interests seem aligned with long-term shareholders.
Okay, so far so good. Strong strategic and institutional backing, founder alignment. But now here's where we see something, let's call it a fascinating contradiction. While these sophisticated corporate partners are pouring in hundreds of millions, validating that long-term vision, the executives closest to the day-to-day operations are actually taking money off the table.
Wait, what do you mean selling shares?
Yes. Over the past year, we've observed a consistent pattern of insider selling by top executives. This includes the president, the CFO, the COO, and the CTO. Just in the 90 days leading up to September 2025, these insiders collectively sold approximately $4.71 million worth of stock. And importantly, there's been no corresponding buying reported from them.
Okay, hold on. The people who arguably know the most about the company's immediate challenges and progress, the C-suite running the show day to day, are selling millions in stock, while big partners like Google and AT&T are buying in or holding large stakes. What does that tell us? Is that a huge red flag waving?
It's certainly a point of concern. It raises an important question, as you said, about their near-term confidence versus the perhaps longer-term strategic view of the corporate partners. Now, executives can sell shares for perfectly valid personal reasons, maybe portfolio diversification, buying a house, taxes, who knows.
Sure, that happens.
But a sustained pattern of selling across multiple top executives without any corresponding buying, well, it warrants careful consideration from investors. It's a signal, and it's one that doesn't perfectly align with the external validation the company is receiving from its partners. It's a data point you can't ignore.
A stark piece of data to chew on. Let's not shy away from other challenges either. Every investment of this nature comes with significant risks baked in. Chapter 6. Risks ahead. Let's shine a sober light on the potential pitfalls here. What could go wrong? Well, the single most significant threat, I think we'd agree, is execution risk. It's enormous. AST SpaceMobile must mass-produce dozens of incredibly complex satellites, execute rapid and successful launches which are never guaranteed, and then flawlessly deploy and commission them into orbit.
It's an incredibly intricate chain. Any significant failure or delay in any part of that process could be, frankly, catastrophic for the company's timeline and finances.
Exactly. Which leads directly to financial risk. We talked about that approximate $700 million annual free cash flow burn rate against the roughly $1.5 billion cash runway.
Yeah, the margin for error isn't huge. Unforeseen costs, maybe a launch failure, needing a replacement satellite, or production delays, any of that could easily force them to raise more capital.
And more capital raises often means significant shareholder dilution, watering down the value of existing shares.
Right. And there's competitive risk. Even with their tech lead in broadband to phone, they face formidable potential competition, especially from SpaceX. SpaceX is known for rapid innovation and, let's face it, deep resources. If Starlink's direct-to-cell service accelerates its development and expands its capabilities beyond just text, it could seriously erode ASTS's first-mover advantage.
That's a big shadow to operate under. What else?
Regulatory risk. Securing and maintaining operating licenses and spectrum rights in dozens of countries around the world is a continuous, complex, and potentially costly bureaucratic challenge. One country changing its mind could cause headaches.
And finally, let's talk market risk. How does the stock itself behave? Oh, it's highly volatile. The stock has a beta well over 2.0, which basically means it tends to swing more than twice as much as the overall market, both up and down. So investors need a strong stomach.
It's highly sensitive to investor sentiment shifts, news flow about milestones, and broader macroeconomic changes like rising interest rates impacting growth stocks.
It also has a high short interest, around 21% of the public float last we checked. That means a lot of investors are betting against the stock, which can exacerbate volatility, leading to short squeezes or sharp drops.
We saw that volatility clearly. The stock went on a meteoric rise from under $2 in April 2024 to over $60 in July 2025, only to pull back significantly into the low $40 more recently.
Looking at technical indicators, it's currently trading below its 50-day simple moving average, the SMA, which suggests some short-term bearishness or consolidation, but it's still above its longer-term 200-day SMA, indicating the underlying uptrend might still be intact for now.
But given all these substantial risks, execution, financial, competitive, regulatory, market volatility, it really begs the question, how much faith can an investor place in a company still very much in the construction phase of its fortress? It's a critical question.
Absolutely. So after this incredibly deep dive into the business, the people, the money, and these daunting risks, what is AST SpaceMobile truly worth? And what's the final verdict for someone considering an investment? Chapter 7, Valuation and Final Recommendation.
All right, valuation. For pre-revenue companies like ASTS, a discounted cash flow or DCF, analysis is really the primary tool. It's like looking into a crystal ball, as you said earlier. You're trying to project how much cash the company might generate way out in the future, and then discounting that future money back to its value today.
But it's highly sensitive to the assumptions you plug in, right? Garbage in, garbage out.
Exactly. It's incredibly sensitive, which is why you absolutely need a scenario-based approach think. A base case, a more optimistic bull case, and a pessimistic bear case. In our base case, key assumptions might include revenue starting to ramp up in late 2025, maybe $50–75 million, that accelerating rapidly to billions by 2030, assuming they hit their milestones, of course. We'd also assume positive operating margins appearing by maybe 2027–28, eventually reaching a mature level around 36%, similar to established telecom infrastructure plays.
And the discount rate, given the risk.
Has to be high. We'd use a high weighted average cost of capital, or WACC, maybe 10% to 12%, reflecting that inherent risk. Future cash flows from such a speculative venture are just much less certain, and maybe a 2.5% terminal growth rate, assuming they eventually mature. What's fascinating here, though, is how dramatically the valuation shifts based on tweaking these assumptions. A slight delay in revenue ramp or lower margins can drastically change the output. It truly reflects the speculative nature.
Do we have any third-party takes on this?
We look at one third-party DCF model from AlphaSpread, dated September 8, 2025. Their base case calculated an intrinsic value of $43.89 per share, and comparing scenarios highlights the range. Their bear case might put the value around $20, the base case of $43.89, and a bull case, if everything goes perfectly, could maybe reach $75. Huge spread.
So very wide range depending on execution. How do other, maybe simpler market metrics stack up? Though maybe they don't apply well here.
Yeah, traditional valuation metrics like price to earnings, PE, are completely meaningless right now because earnings are deeply negative. But if you look at the price to sales PS ratio, well, based on the current market cap, around $15.2 billion and that tiny $4.89 million in trailing 12-month revenue, the PS ratio was over 3,100.
Which just confirms what we know. The market is valuing purely future potential years down the road, not current performance. It's all about the story and the eventual payoff. And Wall Street analysts, what are they saying? Their price targets also reflect that uncertainty, showing a very wide range from about $30 up to $65 per share. The average target sits around $52.24. The overall consensus rating tends to hover between moderate buy and hold.
Okay, now here's the crucial point for any investor, especially a value-oriented one: the margin of safety. With the current market price hovering around, say, $42.41, and our base case DCF intrinsic value estimate around $43.89, there is effectively no margin of safety. They're trading very close to that base case estimate.
So, no discount for all that massive risk we just discussed.
Precisely. And this raises an important question about prudent investing. A conservative investor, faced with this level of execution risk, would typically demand a substantial discount to intrinsic value, maybe 30%, 40%, even 50% as compensation. That essential discount, that buffer against things going wrong, is simply not present here at current market levels.
Okay, so let's bring it all together. What's the concluding recommendation?
Well, for the conservative value investor, based on everything we've discussed, AST SpaceMobile is likely not recommended at this time. It fails the basic tests. It's arguably outside a clear circle of competence for most. It lacks a proven history of profitability, and critically, there's no significant margin of safety at the current price. There's a tangible risk of permanent capital loss if things go sideways.
But what about the other type of investor, the one with a higher risk tolerance?
Right, for the high-risk tolerance, speculative investor. This may be a compelling, albeit very high-stakes, opportunity. You have to view it as an asymmetric bet. It offers potential multifold upside if they succeed, but carries a very real risk of substantial or even total capital loss if they fail.
So, huge potential reward, but huge potential risk. Exactly. It absolutely requires a very long-term horizon, think 3 to 5 years, maybe even longer, to see if the plan plays out. And ultimately, it's a bet on execution. Investors need to focus intently on those critical manufacturing, launch, and operationalization milestones in the coming months and years. That's what will determine success or failure. So what does this all mean at the end of the day? Our deep dive into AST SpaceMobile truly highlights the binary nature of this venture. It's stark. It's a company with a truly compelling, audacious vision. It's backed by genuinely innovative technology and powerful strategic partners. But it faces monumental execution challenges and operates under an urgent financial clock.
It really is a testament to the fact that not all investments fit neatly into traditional boxes. This is way out on the risk spectrum.
Absolutely. And here's a final thought for you, our listener, to mull over. In a world that's increasingly craving universal, seamless connectivity, what role will bold, high risk, maybe even slightly crazy ventures like AST SpaceMobile ultimately play in shaping our future? And importantly, at what cost to those who fund that incredibly difficult journey? Something to think about. If you found this deep dive valuable, we definitely encourage you to like and subscribe to Stock Analytics AI. Members paying just €4.99 a month get priority deep dives on specific tickers you request. Plus, over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those analyses. And if you'd like a one-off deep dive on a specific company that's caught your eye, just drop us a super thanks. We appreciate the support. And finally, the important reminder. The information presented in this deep dive is based on AI-powered research and analysis of the provided source material, current as of September 8, 2025. It is for informational purposes only and is absolutely not financial advice. Always, always conduct your own thorough due diligence before making any investment decisions.